Most people think investing is only for people with a lot of money. They think you need thousands of dollars to start. But what if you only had $100? Is it even worth investing? The answer is yes. Because investing isn't about starting big. It's about starting early. Today, I'll show you how to invest your first $100 step by step in the simplest way possible. Why starting small matters. Many people delay investing because they think their money is too small. They say, "I'll start when I have more money." But waiting has a cost. That cost is time, and time is the most powerful tool in investing. When you invest early, your money can grow through compound growth. That means your money earns money, and that growth keeps building over time. So the most important step is simple. Start early, even if the amount is small. What investing really means? Investing simply means putting your money into something that can grow over time. Instead of your money sitting in a bank account doing nothing, investing allows it to work for you. Some common investments include stocks, ETFs, index funds, businesses. When you invest in a company, you own a small part of that company. If the company grows, your investment grows too. That's how investing builds wealth over time. Don't chase quick money. Many beginners make one big mistake. They try to get rich quickly. They search for stocks that will double quickly, fast ways to make money investing. But investing is not gambling. It's about steady growth over time. Trying to make quick money often leads to mistakes and losses. A smarter strategy is focusing on simple, long-term investments. Beginner-friendly investing apps? To invest your first $100, you need an investment app. These apps allow you to buy stocks and ETFs directly from your phone. Here are 3 beginner-friendly apps. Robinhood. Robinhood is very simple and easy to use. You can invest small amounts of money and there are no trading commissions. Fidelity. Fidelity is one of the most trusted investment platforms. It allows you to buy fractional shares so you can invest small amounts into big companies. SoFi Invest. SoFi Invest is designed for beginners and includes helpful tools and educational resources. The important thing is not which app you choose. The important thing is opening your first investment account. Why you should start with index funds or ETFs. When investing your first $100, the safest option for beginners is usually index funds or ETFs. These investments include many companies in one fund. That means your money is spread across many businesses. Instead of depending on one company, you benefit from the growth of many. This reduces risk and makes investing simpler. Why investing consistently is important? Your first $100 is just the beginning. The real power of investing comes from consistency. Instead of investing once, try investing regularly. For example, $50 per month, $100 per month, or more. Over time, these small investments grow. Avoid beginner mistakes. Many new investors make simple mistakes. For example, checking investments every day, trying to time the market, selling when prices drop, doing day trading. The market naturally moves up and down. Short-term changes are normal. Successful investors focus on long-term growth. Patience is one of the most valuable investing skills. What is the real goal of investing? Investing is not about getting rich overnight. It's about building financial security over time. When you invest consistently, your money starts working for you. Instead of relying only on your job income, you build another source of financial growth. What your first $100 represents. Your first investment is not just about the money. It represents a decision. A decision to start building your financial future. Many people never start investing because they wait for the perfect moment. The people who succeed financially are the ones who simply start and stay consistent. Now here's the real question. If you had $100 to invest right now, what would you invest in first? Once you start investing, you stop thinking only about spending money, and you start thinking about growing money for your future.